Hi, I'm Bill Dooner. Glad to meet you. Our tax firm is based in New Jersey. We specialize in New Jersey inheritance tax and Form 1041 taxes. Quick story. New Jersey is one of the few states that still has an inheritance tax. When a New Jersey resident passes away, New Jersey automatically freezes bank accounts and other assets. So clients come to us to file returns to release funds. And during the initial interviews, when I bring up the topic of Form 1041, without exaggeration, 90% of executors are unaware that most estates must file Form 1041. Also, executors have no idea that they are personally liable for unpaid taxes if they distribute assets without paying estate taxes. This is an excerpt of an IRS regulation regarding the executor's personal liability. The law is very clear about this. You can view the entire regulation at the Cornell Law Information website. This video focuses on Form 1041, and we will briefly cover Form 706 Federal Estate Tax Return, the decedent's final Form 1040, and examples of how income is reported to beneficiaries. First, let's talk about Form 706. I want to clarify a common misconception about this form. We constantly hear clients say something like, "Hey, Bill, my lawyer said the estate is less than $13 million, so we don't have to file an estate return." This is true. In 2025, the exact amount is $13.99 million, and in 2026, it goes up to $15 million. This exemption applies to Form 706, which reports asset values owned by the decedent at time of death. So, if the estate's assets in 2025 are less than $13.99 million, you usually do not have to file Form 706. However, Form 1041 is a completely different animal, and Form 1041 is required if the estate receives income over $600. Now, let's clarify the difference between the final 1040 and Form 1041. After a person passes away, the executor not only has to file the final Form 1040 for the decedent, the executor will also need to file Form 1041 if the estate received income over $600. Bear in mind that a married taxpayer will usually file a normal Form 1040 as surviving spouse. So the following examples in this video may not be applicable. Also, if the spouse is receiving all the assets of an estate, the surviving spouse will usually not have to file Form 1041. So bear that in mind. Here's how this works. Let's say someone passes away and they are single, unmarried at time of death. Their income, like salary, interest, dividends, up until the date of death, goes on a final Form 1040. But any income the estate receives after the date of death is reported on Form 1041. Think of Form 1041 as the estate's own income tax return. Here's a simplistic example. Let's say John, he's single, he has a $100,000 CD in his savings bank, and he passes away on March 31st. And the interest earned on the CD from January 1 to March 31 is $1,000. The $1,000 will be reported on his final 1040, together with any other income like Social Security or whatever he may have. Now, let's say 6 months go by from April 1st to September 30th. The CD earns an additional $2,000 in interest. On September 30th, the funds in the CD are distributed to the beneficiaries. During the 6 months post-death, the CD earned $2,000 in interest and will be reported on Form 1041. Now, let's go over who must file Form 1041 and who doesn't have to file. If the estate receives more than $600 in gross income, it must file Form 1041. You do not need to file Form 1041 if the estate earns less than $600 in gross income after the date of death, unless there's a beneficiary who's a non-resident alien, such as a non-U.S. citizen living abroad. Now let's talk about the filing due date for Form 1041. As the executor of an estate, you probably received an EIN number from the Internal Revenue Service. You could open an estate checking account. Here's a typical EIN letter advising the executor that Form 1041 must be filed by April 15th. By default, Form 1041 is due by April 15th if you use a calendar year, but you are not locked into this date. The states have a special provision that allows the estate to elect a fiscal year instead. This means you can choose any month end within 12 months of the date of death. A fiscal year allows the beneficiaries to shift reporting of the income and losses from the current year to the following tax year. Why would you use a fiscal year? Well, it gives you more flexibility for tax planning, which can be a big help if you need extra time to collect income, pay expenses, or distribute funds to beneficiaries. In our tax practice, we love the fiscal year option because it allows for hindsight tax planning. We can look at the estate's income and expenses for the year and make smart decisions about when and how to distribute income to beneficiaries, possibly lowering the tax liabilities. In a moment, we'll go over a couple of examples to illustrate how beneficiaries report income and losses on their personal 1040 returns using Schedule K-1. Before we go over the examples, I want to remind viewers, do not rely on videos for tax advice. Returns such as Form 1041 can be complex. Whether you engage our firm or another firm, the smart move is to hire a credentialed tax accountant that specializes in Form 1041. If you're an executor and need help, contact us for a free consultation. Our website is estateexperts.com. So what happens to the estate's income? The income is first reported on Form 1041, and if the estate is required to report the income out to beneficiaries, it is usually reported to them on Schedule K-1 so that the beneficiaries can include the income on their personal Form 1040. The estate gets a deduction for what it pays out, so the money is not taxed twice. By the way, the estate does not have to use a K-1 schedule. It has the option to pay the tax directly to the government via Form 1041. However, most estates will pass through the income to the individual beneficiaries because the Form 1041 tax rate can rise as high as 37%. Most individual beneficiaries are in a lower bracket, so using a K-1 schedule will usually result in a tax savings. Here's a quick example. Let's say the estate, after expense deductions such as executors' commissions, legal, and accounting fees, the estate earns $30,000 net after expenses and dividends. And there are two equal beneficiaries, each getting $15,000. The $30,000 is shown as income on Form 1041, and because it's being reported to the beneficiaries on Schedule K-1, no tax is due on Form 1041. So each beneficiary is going to report $15,000 on their respective Form 1040s, which gets added to their other income. Each beneficiary reports to K-1 on their personal 1040, which is due April 15th. Otherwise, if a fiscal year is used, the income may be shifted to the following tax year, meaning that's an extra 12 months, which is a big benefit in many cases. Here's another example. Let's say the estate sells a house. When someone passes away, their property such as stocks and realty usually gets a stepped up basis, meaning the value resets to the fair market value at time of death. If the estate sells the house for less than the new basis, it has a capital loss. The estate can allocate this loss to beneficiaries using a K-1, and they may be able to offset gains on their personal tax returns. Remember, closing costs such as commissions and other expenses can reduce the taxable gain or increase the loss, which is passed through to the beneficiaries. Let's show how this is reported. Let's say the estate has a residential home that was worth $500,000 at time of death. 6 months go by since the date of death, and the house is sold for $490,000. However, because of realty commissions, closing costs, carrying costs, the estate only receives $460,000. They sold for $490,000, but after expenses, the estate winds up with $460,000. This results in a $40,000 capital loss. The property was worth $500,000 at time of death. The estate only received $460,000 after expenses, so their loss is $40,000. Let's say there are two beneficiaries with equal shares. Then the K-1 will report a $20,000 capital loss on Schedule D for each beneficiary, which can reduce their personal 1040 taxes. Besides capital losses, estates have a special provision that allows them to deduct legal, tax, accounting fees, executor fees, etc., that are an above-the-line deduction, which can be a major tax savings to the beneficiaries. This is why you should engage an experienced tax professional. So, to recap, the final 1040 covers income up until the date of death. Form 1041 reports income after the date of death and is required if the estate earns over $600. You can choose a fiscal year for more tax flexibility. Income and expenses can be passed to beneficiaries using Schedule K1, which beneficiaries then report on their personal Form 1040 returns. If you're the executor or administrator of an estate and need help with Form 1040 or Form 1041, check us out at estateexperts.com to schedule a free telephone conference to discuss our services. Also, you can schedule a call directly by using the calendar feature on our website. I will leave a link in the description. Thanks for watching. Have a great day.